In my first year in the US, I overpaid my taxes by around $6,000 Canadian. In retrospect, this was a big mistake and I could have lowered that amount by a lot or potentially even paid zero. In this video, I'm going to be breaking down some of the background information that you need to do your American and Canadian taxes, as well as be giving you what I did on my personal taxes and what mistakes I made and what I would do differently. So hopefully you'll be able to take all this information that I'm about to lay down. You can take that info, go to the accountant and not make the same mistakes that I did. And before we continue, I have to make a disclaimer. I was honestly really hesitant to make this video. I've had this video requested a lot of times in my YouTube comments and as well as like getting it suggested by my friends or other people that I know. But the reason that I'm hesitating is because I don't want to spread any misinformation. In no way is this video a how to do your taxes. It's more so showing you what I researched, what I did, and what I learned when I did my own taxes when I moved from Canada to the US. With that being said, I'm not an accountant. You should talk to an accountant. And if you watch this video, not talk to an accountant and end up losing money, I'm sorry, you're an idiot, but that's your fault. Okay, with that big disclaimer out of the way, let's begin. The first thing I had to understand was tax residency. So as someone that's going to be moving from the US to Canada, you have two options in terms of tax residency. Number one is a tax resident in Canada, and number two is a tax resident in the US. And depending on which country you're a tax resident of, is going to change how you do your taxes and how much you pay and all these other things. So if you're coming to the US on a TN visa, you're going to be considered an alien. It's a weird word, I know. I don't really know why they picked it. But anyways, as an alien, you can be either a non-resident alien or a resident alien. So to be considered a resident alien, you have to pass the substantial presence test, which states an alien individual will meet the substantial presence test if the individual is physically present in the USA for at least, number one, 31 days during the current calendar year, and number two, 183 days during the 3-year period that includes the current calendar year, and the 2 calendar years immediately preceding, counting A, all the days physically present in the US during the current calendar year, and B, 1/3 of the days the individual was present in the first preceding year, and C, 1/6 of the days that the individual was present in the second preceding year. Now, if you meet the substantial presence test, you are deemed a resident alien for US tax purposes. And that means you have to pay tax on everything you earn in the US from the date that you become a resident alien, as well as all the worldwide income from that date to the end of the year. On the flip side, if you do not meet the substantial presence test, you are considered a non-resident alien, and you will only have to pay tax on all of the US income that you make and not the worldwide income. On top of that, there's a special rule for the first year that people move to the US called the first year choice rule, which states an alien individual who is classified as a non-resident of the United States for the entire calendar year immediately preceding his or her first calendar year as a US resident under the substantial presence test may nevertheless be able to elect and to be treated as a US resident for part of their immediate preceding calendar year by making this special election. Now that's a lot of words to basically just say if you come to the US and it's your first year, and this is only your first year, you can elect to be a resident alien of the US for tax purposes, regardless if you pass the substantial presence test or not. Now all of that probably sounded really complicated, so what I'm going to do is I'm going to make an example or a scenario which I think is pretty common. Imagine that you are freshly graduated from a postgrad degree or like a university degree, undergrad degree, it doesn't really matter. Or you have been working for a couple of years and now you're going to get a TN visa and move to the States. If you move to the USA before July 1st, which is 182 days into the year, not counting leap years, you are deemed a resident alien of the US because by the end of the year, you would have stayed 183 days in the US, assuming you don't go on vacation or whatever. Now let's say you moved after July 1st. Let's say like August 1st. If this is the case, you will become a non-resident alien of the US for tax purposes because you failed the substantial presence test. But regardless, in either case, you can elect to be a resident alien of the US for tax purposes by doing the first year choice rule. Now I can totally get that this part is confusing. When I was looking over this, I had to read it like 2 or 3 times when I was first moving. So if you need to go back, pause, rewatch, read the snips I have on screen, look at some of the links I have in the comments so that you can really understand the residency part before we go on to the next section. So now that you understand the tax residency, now we have to file some taxes. So now it's when it gets a little bit more confusing. Like I said, depending on what kind of tax resident you are is going to affect how you pay your taxes. And one big factor in determining if you're going to be a non-resident alien or a resident alien is your departure date in Canada and the taxes you have to pay when you exit Canada. So on the day that you leave Canada and stop being a Canadian tax resident, you have to pay an exit tax. This tax does what's called a deemed disposition. And what this basically means is they're going to add up all of your assets. So all of your stocks, all of your houses, all of your rental properties, all of that, you're going to add it up and then you're going to calculate the capital gains as if you had sold all of those investments and then rebought them immediately. Now the capital gains that you get is what you're going to have to pay back to the Canadian government, and this exit tax is calculated on the last day in Canada or your departure date. After you do the deemed disposition and you do the on-paper selling of all of your assets, you get an adjusted cost basis, and then you can bring those assets with you to the US or to whatever country that you're going to be moving to. So for your departure tax, you have 2 choices. Choice number 1 is the day you actually leave Canada and move to the USA. So for me, that date was August 25th, 2021. The other option you have is to make your departure date the last day of the year. For me, that would have been December 31st, 2021. All right, so I'm just doing some editing right now, and I think I may have made a mistake. So I know that I said that you have 2 options for your departure date, but that is only because I was a non-resident because I didn't pass the substantial presence test. So I think if you do pass the substantial presence test, I'm not sure if you're able to choose your departure date to be the last day of the year, or if you have to make it the day that you actually left Canada. So that's just something I want to note while I was editing. I noticed that. So again, go talk to account. Bye. Okay, so option number 1, if you choose the day that you leave, which in my case was August 25th, 2021, you will pay your departure tax. Then you will elect the first year choice in America and become a resident alien for the first year in America. This way, you would only be responsible for your Canadian taxes up until August 25th. And then after August 25th until the end of the year, you'll be responsible for the American taxes on the American side, as well as all of your worldwide income that comes from your investments. You also have to pay tax on that in America. So option number 2, this option is you are choosing your departure date to be the last day of the year. In this scenario, you're a Canadian tax resident for all of 2021, and you are a non-resident alien for tax purposes from August 25th until the last day of December 31st in 2021. So that means I would only have to pay taxes on the American income I made and not any of the other worldwide income. So from the American taxes side, it's pretty simple. You're only paying taxes on the income that you made. But on the Canadian side, things get a little bit more complicated. Since you're a Canadian tax resident for all of 2021, that means you have to pay tax on all the income that you made from your Canadian job or whatever from January 1st all the way until August 25th. And then you move to the US, blah, 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 blah. But when you do your taxes in 2022, you would also have to file that you made income in the US from August 25th all the way until December 31st. Now, if you do this option, you will get a foreign tax credit because USA and Canada have some tax treaties. But to be completely honest, I don't really know much about this tax credit because I didn't choose this option. So this is definitely something you should bring up with your account. Okay, just as a quick note, I'm talking about paying this tax and departure and all that in the present tense because it makes it easier to say. But in reality, you're gonna have to do all this and pay all this tax when you do your taxes in the year after. So for example, my departure date was August 25th, 2021. So in April of 2022, when I'm doing my Canadian taxes, I write down that I departed on August 25th, 2021. That's when I actually do my taxes and pay my departure tax. Okay, so I know that must have been a lot to go through just now. So go back, rewatch it, and click some of the links if you're a little bit confused. Even though I listed those 2 options, there are probably more that I'm not aware of. These are the only 2 ways that I personally looked at it when I moved from the USA to Canada, and that's what I'm familiar with. Okay, next, let's talk about investment accounts. Your TFSAs will have to be emptied before your departure date. From what the accounts have told me and the research that I've done, this is very important for 2 reasons. Reason number 1 is that TFSAs are not recognized as tax-free savings accounts in the US and instead are counted as foreign trusts. I'm not exactly sure on that one. I'm not an accountant. And because of that, it's taxed differently and you have to file an additional form when doing your taxes to keep your TFSA. Shout out to my boy Tristan who has kept his TFSA and told me how annoying it is and how much of a chore it is to keep it during tax season. Reason number 2 has to do with departure tax. Let's say on August 25th, I move to the USA and become a resident alien of the US for tax purposes. And then let's say on August 27th, I sell my TFSA. Now, since I'm a resident alien of the US, I have to pay tax on all my worldwide income, which includes the selling of my TFSA. Now, this completely negates the whole entire point of the TFSA because I have to pay tax on it. So it's not something that we want to do. Now you can easily avoid this situation by just emptying your TFSA while you're still a Canadian tax resident. Another thing to note is your RRSP. From what I understand, their RRSP is completely fine to keep. While I was in Canada, I never opened an RRSP, so it's not something you know a lot about. So if you have an RRSP and you have questions, this is a great thing to bring up with your accountant. You can also keep your regular brokerage account. So when I moved, I had a brokerage account with Equestrade and I still have it to this day. Now, if you choose to do this, that means you've already paid your deemed disposition and your exit tax on all of your assets in your brokerage, and you now have an adjusted cost basis. Now, if you keep your brokerage account like I did, every single year you'll have to file the FBAR. Now, the FBAR is a form that you have to file every single year during your taxes that basically lists out all the foreign accounts that you have while you're in the US. So for me, that's just my Equestrade account and my CIBC account. On top of that, you also have to manage your brokerage account from the US. So every single time you sell a stock in your brokerage account in Canada, say for example Equestrade, you have to then file the taxes for that in the US. Now, there are also some extra caveats to having your brokerage account in Canada while you're in the US. One of them is if you're getting income through your investments, say for example a dividend, the brokerage is going to hold back 25% of that income and remit it back to the CRA. Also, when you move to the USA, you should change your address on your Equestrade account or on your whatever account to be your American address. Now, once you do that, they're going to disable the buying power from your account and you're only able to do liquidation like activities. I mean, you could not do it, but honestly, I don't really mess around with this tax stuff. You want to do this really really by the book. So again, that's why you should talk to an accountant. Okay, so I think that basically covers all the research that I did and all the things that I had to go through when I was moving to the US. Now I'm going to be talking specifically about my own personal situation, what mistakes I think I made, and what I would do differently now that I know what I know. Okay, so I graduated from my undergrad degree in March of 2021. And then I took a big break. I was not able to do a lot of traveling because it was during COVID, but I was supposed to. But anyways, I moved to the States and started work on August 25th, 2021. So since I was a student for the whole entire year, I did not have any Canadian income. And before August 25th, I knew that I was moving to the States and I did a little bit of research. So I sold all of my TFSA, I liquidated it, and I put it into my brokerage account. So with my TFSA and my brokerage account together inside the brokerage account, I had just over $60,000 Canadian. Aside from that, I didn't have any other investments. I didn't have an RRSP, and I had very little cash savings. All right, so then August 25th, I moved to the US. Everything is fine and dandy. Okay, so time skip. Now it's 2022 and I'm doing my taxes. I go with option number one, which I had listed a little bit earlier, which was basically I moved to the US on August 25th. Then I do my deemed disposition and make the August 25th my departure date. I then elect the first year choice rule and become a resident alien for all of 2021. Now with the departure tax on that date, I had to pay just over 6,000 Canadian dollars in taxes. I think it was like 6,300 Canadian. And I have to file the FBAR on my Questrade account, which is still in Canada. And I had to do that for 2022, and now I have to do that every single year. Now here are the mistakes that I made and what I would have done differently. I really should have talked to a cross-border accountant before I left Canada. Like the moment that I signed that offer, I wish I could have told myself like, yo, literally go find an accountant, talk to them now and figure out what you have to do. In my first year, I had my uncle help me with my American taxes because he's an accountant. He knew how to do it, but he's only specialized in American taxes. He doesn't know much context about this cross-border stuff. And I thought I was getting a great deal. I'm like, oh, I'm so smart. I figured it out. I know how to do everything. I looked at it on the Canadian side. I'm blessed. I looked at it on the American side. My uncle's doing it. We're super good. But joke's on me, I had to pay over $6,000 in taxes. Now, I know a lot of tech companies will give people in their first year that are moving from Canada to the US a cross-border accountant. I know Meta does this for sure. Now, say for example that you are going to go to Meta and you just heard what I said. You're like, okay, awesome. I don't have to worry about anything. I'm good. That's not necessarily true. By the time that you talk to these cross-border accountants, it's probably going to be the year after. So say for example, I moved in 2021. I'm realistically only going to start worrying about my 21 taxes in 2022. So that's when I'm going to reach out to the cross-border account. But by that time, it's already too late to do a lot of things that would reduce your taxes or would make you in a more advantageous position. A lot of the stuff that matters has to be done before you leave Canada. For example, your TFSA. So my particular advice is, well, I mean, it is for the whole entire video, is go talk to an accountant. But for this tip specifically, go talk to an accountant before you leave Canada. I think that is the most important thing that you could do. Okay, with all the information that I have now, the second thing that I would have done differently is I would have moved all of my money with me when I moved to the USA. I would have sold all my investments and brought it with me using Norbert's Gambit, and you can Google what that means. I really dislike having my money in separate places. It's honestly really annoying to deal with. Now, I know the FBAR is only one form that I have to do every single year, but just the thought of having my money in two separate places is really annoying. And in reality, it would have been so much simpler if I had just brought it all together in one place. I wish I had sold all of my investments and not done a deemed disposition. The reason for this is because in 2021, I was a student and I had no income. If I had sold all of my investments before I moved to Canada and then brought those investments with me, I likely would have paid like little to zero in taxes that year. Now, the reason for this is that in Canada, you are taxed on 50% of your capital gains. So for example, if I made a trade, I made $20,000 on that trade, I would only be taxed on $10,000 of it. And what would happen is that they would take your $10,000 that you made, which is half of your capital gain, and then they would add it to your income, right? But since I was a student, I had zero income. So I add $10,000 to it and I have to pay tax on $10,000. And since I was in such a low tax bracket, I would have to pay very little, if not nothing, in capital gains tax. Then I would have been able to bring my money with me to America, thus saving me from the headache, saving me that $6,000 in taxes, and saving me from filing the FBAR form every single year. Now, another thing that I would have done differently knowing what I know now is I probably would not have made myself a resident alien of the US. I actually think doing a little bit more research in making this video, it's probably simpler to be a non-tax resident of the USA for the first year and then just become a Canadian resident for the whole entire year and do the whole entire foreign tax credit stuff. But I was so adverse to that because I didn't want to pay an accountant to do the foreign tax credit because I didn't understand it myself. So I was like, I don't want to do that. I can just not pay an accountant and do it all DIY. And that ended up biting me in the butt. But as you can see, even though this was all pretty complicated, my situation was relatively straightforward. I was a student with zero income and some investments. I could not imagine how complicated this would be if I owned an investment property or I was married or even if I had a job. And even with a case so quote unquote simple as mine, I still made a mistake and had to pay over like $6,000 in taxes. So the moral of the story is, if you're going to be moving to the USA, please talk to his cross-border accountant specifically before you leave Canada. All right, so that was a lot to go through. So if you're still here, your brain's intact, you actually understood what I'm talking about, because I know that this video is probably super jumbled. Pat yourself on the back. You did a great job. It's great that you care enough to look at your personal finances and actually look at this sort of stuff. Now, hopefully, if you're watching this earlier enough, you can talk to your accountant and maybe catch some of the mistakes that I made. And I know this all sounds really confusing and it seems really daunting, but it's only really bad in the first year. So what you can do is you can pay for the account in the first year, and then after that, everything is pretty smooth sailing. So after 2021, all my taxes, so my taxes in 2022 and now taxes in 2023, I just file online like any other American. I personally use Free Tax USA because it's the cheapest from the options that I've seen, and they file your federal taxes for free. And since I live in Washington, I get to file my taxes for free. The only additional thing I have to do on my taxes is the FBAR, and like I said earlier, that's pretty simple. Now, again, I really want to stress how important it is to talk to a cross-border accountant. It's highly worth your money, especially since you're probably only going to be doing it one time. Now, I wish I had a cross-border accountant that I could recommend, but I do not have one. For number one, no free promo, and number two, I don't personally know anyone that would want to sponsor me. So if you're somehow a cross-border accountant watching this, hit me up, let's work something out. Aside from that, I hope you enjoyed this video. Please consider liking and subscribing. If you have any questions or video ideas, please feel free to leave them down in the comments below. And if you're fresh on a TN visa and you're wondering what things you should do, what things you should look out for, you should watch this video right here where I go over 5 tips that you should know once you're on your TN visa.